Equities are near all-time highs, while interest rates haven't fully retraced back to their pre-Iran conflict levels. Meanwhile, a new Fed chair is on the horizon. So what does it all mean for fixed income investors? Well, we're going to break that all down for you right now on UBS Trending. Hi, everybody, and welcome to UBS Trending. I'm Anthony Pastore. Thanks for joining me today. I'm excited to get into my conversation with my friend and colleague, Leslie Falconio, who's back to break down the latest on what's going on with the Fed, the economy, fixed income. Leslie, there's a lot to talk about. Every time you come through, I feel like I always start with, there's a lot to talk about.
I'm a leading indicator.
You should be. The Fed should be looking at everything you're talking about.
That's right.
Well, let's talk about that because clearly, as our audience knows and as we know, there's been a lot of back and forth with this Iran conflict. News changes almost multiple times a day. And so it's really hard to kind of determine where we're going, what's going on. Even, some Fed presidents and voting members have come out and said, the uncertainty, the risks that are involved with this conflict continue to remain elevated. So I mentioned in the intro, equity markets are near or at all-time highs, but fixed income markets, rates have not really kind of retraced back to their pre-Iran conflict levels. Why do you think that is? What's going on with the rate market right now?
Well, listen, even prior to some of the disturbance that we saw today, which are causing interest rates to rise, but let's just say from the end of April. So if you look at when the ceasefire began, let's just say it's around April 7th-ish, to the end of the month, you had sort of this risk-on mentality throughout, right? Vol came down, equity at one point reached a new high, spreads compressed, and the only thing that really stayed at these, this was all to pre-crisis levels. The only thing that stayed, as this chart shows, to levels that were higher than, say, what was at the end of February were interest rates. And the main reason to that is the market doesn't believe that the Fed is going to cut in 2026. As a matter of fact, you and I were talking earlier, as of today, and we know this changes very quickly, it actually had a hike priced in for a 30% probability of a hike priced in for 2026. But let's just say if we go to the end of the month or some point last week, it was a higher for longer mentality that the market had, without the Fed cutting for until the end of 27. And one of the reasons why that is that inflation expectations, sort of like the longer this ceasefire goes on, we know that initially, and this chart shows this as well, initially that break-even inflation expectations went very high in the short end, right? Because oil hits consumers in a shorter period of time, gasoline, electricity, all those types of things. Right. But the longer that you are sort of in the ceasefire for, it starts to, in fact, impact the back end. And that's really what we're seeing. So we're seeing that back end, that 10-year inflation expectations start to rise. As a matter of fact, it had gotten to around 247, 248, which is the highest that we've seen since February 25.
Right. And we know that at the most recent Fed meeting, Fed Chair Powell's last meeting as the Fed chair, I should say, there were 4 dissenters against the decision to keep rates unchanged. It's interesting to see as he's transitioning out and possibly Warsh coming in as the new Fed chair once he gets voted on and takes the chair, which looks like it's going to happen. His stance on monetary policy is slightly different. But again, it's hard to know where we're going, considering that there's so much uncertainty in the markets and in geopolitical news. Yeah,
there's no question. And to your point, one of the things, when we had this dissent, Myron, who wanted to cut. No big surprise there.
Yeah, right.
Some people didn't believe, Kashkari, and some didn't believe the language that they had, the easing bias that was maintained. But, to tell you the truth, Anthony, it really didn't matter because the market's not pricing in an easing. Right. So that kind of impact to the marketplace really, except for you haven't had for since 1992 or something like that. It was great in terms of headline, but the market wasn't pricing in an easing anyway. So that actual impact wasn't that great, particularly to things like spreads.
Right. Which, by the way, we just talked about reverting to their pre-crisis norms, but you're still in favor of high quality right now. Talk about your conviction on that.
Yeah, there's a couple things. One of the things that, there's 2 things. One is that lower credit quality has actually been the dominant driver. And, what we're showing in this chart is how some of these spreads have changed for both high quality and those sectors that are more credit embedded, right? And the sectors have really tightened in since pre-crisis levels. So you don't want to say, well, nothing really happened, but it is quite incredible how resilient these credit spreads have been. And, for the month of April, high yield did incredibly well, right? The spreads compressed. You've got a lot of income there. It's one of the top performing sectors. But this concept right now of the potential higher oil prices, hurting consumer demand doesn't seem to be in the picture right now, which I find surprising because the longer this goes on for, growth is going to slow.
Right. And we were just talking about the yield curve before we started as well. And then the long end of the curve right now, you're looking at, 10s, 20s, 30s are much higher than the shorter end. But that could shift at any time depending on the news coming out of Iran or anything else that's happening in the markets, right? I mean, so it's not like we're going to see this sort of normalized upward sloping curve forever. It could change depending on what happens in the markets.
It could. Listen, I don't think the curve. I don't think the curve inverts. I think the upward sloping yield curve remains.
Right.
But to your point, if the market should continuously price in hike, then you have the potential. 6-7 months from now, the market pricing an inverted yield curve. I don't put a high probability to that, but it's not impossible.
And does CIO still believe that the Fed is going to cut twice this year?
Yeah,
that hasn't changed at this point.
No, it hasn't. We still have 2 cuts by the end of the year, and as I've said before, the timing of the cut, whether it's September or December, doesn't really matter. What matters is that it's a cut, not hike, at the end of the year, which we do believe it will be. And as I'd mentioned, I mean, the market's just not. The market's sort of focused on this inflation impact. The fact that the economy is strong, 4.3 unemployment rate, retail sales are strong, claims are down, but it's not really looking ahead and saying, what could potentially happen to growth and, that headwind to consumer demand as they go through their, tax refunds.
Right. And as we see, higher quality total returns are still outperforming cash, given where rates are. So what are you advising our investors, our clients to do now that we may have a higher for longer Fed in place?
Yeah, listen, cash, there's a lot of cash on the sidelines still, and which when you have uncertainty, that has a tendency to happen,
Sure.
Of course. I mean, you can't fault that. But, one of the things that we blogged about and one of the charts showed was if you look at the total return, here it is, of different fixed income sectors, and that with cash, yes, cash has been, an okay performing sector. It's yielding fine given the fact the Fed is not, or the market's perception is the Fed doesn't cut.
Right.
So you're going to keep those interest rates elevated. But again, it's our expectation that in the second half of the year, when you go through some of these cushions of tax refunds and, consumers start, pulling back a little bit on that discretionary spending, you're going to have growth slow. And so the reinvestment risk we think is going to be there on the cash side. So we like that higher quality sector. We like keeping it in our interest rate exposure more in the short end of the yield curve. We're not willing to go back end yet, simply because there's too much unknown in terms of deficit, in terms of inflation impact, or length of the ceasefire.
Right. I do want to go back to potentially future Fed Chair Kevin Warsh, as he is expected to be confirmed, and that his tenure is supposed to start mid-May. But of course, we know that Powell has announced that he's going to stick around after he leaves the chair to be still on the board. So he still has some influence in the room. But do you expect any kind of market volatility as Warsh kind of takes over and starts to implement more of his monetary policy stance and beliefs to the FOMC?
There's always volatility when a new Fed chair comes on, simply because they have a different communication style, right? And you saw it with Bernanke and Yellen and Powell. When they first started those first few Fed meetings, they have a tendency to, make a few communication, errors with the market likes to respond to, but everyone has a different communication style, and the market needs to get used to that. So it's just going to be volatile, or volatility is going to increase just through that. Now, do I think that, the recommendations that he has put on the table without a tremendous amount of depth, I might add, comes through? Not for the first several months, And even those that he's recommended, whether it's balance sheet or even just simply altering which inflation measure you look at, this takes a long period of time. And again, as you mentioned, Powell's still going to be, on the board, maybe not until 2028, but he's going to stay for a while, and it is by committee. So I expect the volatility just to come naturally. Just just because he has a communication style that's different. He doesn't need to change anything to get that volatility to happen.
It took
and plus, you're coming from a very low level.
That's right. Yeah. And it took all of us a little time to get adjusted to Powell's sort of style of communication.
Every time.
Every time. And I remember there were a lot of headlines about Powell and his communication style.
Right.
So, and now we're used to the way he communicates. So obviously, yes, we'll have to.
Although with Warsh, you might get the Q&A quarterly and not monthly because he doesn't want a lot of forward guidance.
Okay.
But even that quarterly one, everyone has their own style.
Right, exactly. And last question, Leslie, because it's always fun to ask you this. The opportunity right now for fixed income investors, where are we sticking with?
We're still in that short end of the yield curve. It's that 2 to 5 year area. It's a great place to compound that income, keep that capital preservation and high quality. There's no reason to go out further to your skis yet in terms of interest rate risk. I believe there will be at some point. And probably it could be in the near future, the way that things are developing right now. But right now, we're going to stay with that 2 to 5 year. We're going to stay at that high quality, and that compounding income is going to be the tailwind to total return because I don't see a lot of spread compression from here, given how well things did and recovered in April.
Great, and Leslie, thank you very much. Always good to have you join us.
Leslie
Falconio from the Chief Investment Office, and thank you for joining us today for this episode of UBS Trending. There's lots more information coming out of our Chief Investment Office, including everything that Leslie's discussing at ubs.com/views. That's our Insights website. Plus, you can follow UBS on social media. We're on LinkedIn and Facebook. Plus, you can follow UBS Studios on our dedicated Instagram channel at UBS Trending. Lots of content there for you, so give us a follow. And as always, if you have any questions about what Leslie and I spoke about today, please continue this conversation with your financial advisor. Until next time, I'm Anthony Pastore. Have a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody. Thank you.